All right, welcome to our reading charts portion of our fundamentals section. On this portion, we'll be looking at the basics of reading the Forex charts. My name is Jared Passy with lots of pips. Let's see what we've got here. Well, here's an example of a chart. Okay, this is a candlestick chart, which we'll talk about a little bit more in a little bit. But this is just an example of a chart. Down across the bottom, we have time. Okay, all the dates, these here are daily, or nope, these are 5-minute charts. So each one of these candles represents 5 minutes of time, of movement in the market. The market moved less during this 5 minutes than it did during this 5 minutes. It moved quite a bit more. So this is time, and this is pip value. Over here, the price, the exchange rate between the two pairs. The US dollar is at the top of the chart, and the Canadian dollar is the bottom of the chart. The US is the base, the Canadian is a quoted pair. So as this climbs up, the US is strengthening against the CAD. As it drops down, the CAD is strengthening against the US. Every candle represents 5 minutes. So let's take a look. This is just a quick and easy example. On this chart, the markets and these charts fluctuate. Okay, all the time. They're hardly ever in a constant motion one way or another. They're always fluctuating. We call it breathing. The market moves up, and it pulls back. And the market moves up, and it pulls back. And the market moves down, and it pulls back. And it pulls back, and it goes up, pulls back, goes up. The moves that are going up that have some amount of force or progress, that make progress, are called, progressive waves or drives. And the ones that are pulling back down are called pullbacks or retracements. Okay, so this market is moving down, and it came back up to about the same level. So we're kind of in a channel here, just kind of going up. Didn't go down very far, didn't go up very far, but now we've made progress going down. So we're in a downward trend, and there's a retracement, but it didn't make a new low. So now we might be moving into an upward trend, which sure enough, we made new high. Didn't come down as low, so we're still making new progress up. So this is kind of a downward trend here, and we changed directions where now we're in an upward trend where the market's just kind of trending up and working its way up. And that is basically, a chart. All right, different types of charts. Now we use candlestick charts in all of our trading, but we want to introduce you to some of the other charts you might be able to use for different purposes. This is a line chart. Shows the exact same information on your chart, but it shows it represented by a line. The line actually correlates to the closing distance of each, or the closing price of each one of the candles that you have. Okay, then we have our bar charts, and as we see the bars, they're similar to candles, but they don't have the fat body part. They just show you where that price opens on that for that time frame and where it closes on that time frame. And then we have the candlestick charts, which is our favorite here, just like the ones we were looking at earlier. All right, so those are the three types of charts that you can use on your charting software, whichever one that is. All right, let's take a look at candles. Candlestick charts are the most common, like I said earlier. Candles can tell us, okay, each one of these is considered a candle, and it looks like a candle, so that's why they call them candlestick charts. You got this big fat part and a little wick on the top. And so on each chart, the fat part is called the body of the candle, and then the wick is called the wick, the piece that sticks up at the top, and the piece that sticks up down the bottom, if there is one, is called the tail. All right, so each candle represents a certain amount of time. Okay, so if this chart were a 1-hour chart, then each one of these candles represents how much the market moved and where it opened and closed during that hour. And then when the new hour starts, it starts making a new candle. Okay, so in each candle shows us the net gain and the net loss of each time period. Shows us the time, how much time, shows us the extreme high and the extreme low of that time period. So during this 1 hour, this candle chart opened right here at the top, because that's where the previous candle ended. Okay, the blue candles are candles that are climbing, and so the close of that candle is at the top, and that starts the next candle. So this one opened here, and then during that 1 hour, the candle moved a total, the extreme high, the highest point it got during that hour was right here, and the lowest point, the extreme low that it got during that 1 hour, the price was right here. And then this, in the red body part, is basically the net amount that this one actually lost, the net loss in that hour. So it opened here, it closed here, and during that hour it went as high as here and as high as here, but it closed here and then started our next candle. And also shows us the market sentiment. It shows us whether we're strong for the base pair or strong for the quoted pair. All right, so let's look at chart patterns. A lot of traders use chart patterns to come up with when to get into trades and when to get out. They provide us clues as to how the market might act from here on out. You want to look for probabilities in how the market's going to react. You don't want to just be guessing. Oh, I think it's going to go up or I think it's going to go down. Isn't going to make you a lot of money in the Forex market. You have to have reasons. You have to have things that you've tested that have some level of probability to them. And that's basically what you're learning when you're trading when you're learning to trade foreign currencies, is how to recognize the probabilities and be able to capitalize and make money on that. So we're looking for probabilities increase, and so let's look at some major patterns. First of all, let's look at double tops and double bottoms. Okay, so the market this is a reversal pattern, which means that with this pattern, we expect the market to change directions and start going the other direction. Most patterns are reversal patterns, though not all. Okay, so here we got the market came down, went down, tagged a low, came up, hesitated for a bit, went down, tagged the same low, but didn't go too much past it, and came up and changed direction, going the other direction. So it came down, hit a low, couldn't break it through, so the market sentiment is that, okay, we don't have enough selling strength to continue going down, so it looks like we're about to change direction. So anytime in this area, when it hits this second low, is a good time to look at placing a trade going long, because it's failed to make a new low, failed to continue the trend, so it must be changing directions. Or it may still go sideways, but that gives us an idea or a clue. Remember, we're looking for clues that this might be climbing back up. And so that is a double top or a double bottom. It's the same thing in reverse when it comes up and hits the top twice and then drops back down. Another one is a head and shoulders. Now this one was where, this is also a reversal pattern, where the market climbs up, hits the top here, comes down, retraces, climbs up. That's nothing new. That's just an upward trend. But when this, from the next high, when it comes back down almost all the way or a little bit more than it did on the left side of this, okay, when it comes down in one motion and almost comes down, I usually go for about 85% of this move up. It comes back down. Then I start looking for head and shoulders. And so what I'm expecting is it not to go up and make a new high, but I'm expecting some kind of climb right here and then another move back down. So I usually take the top of this left shoulder. Okay, so this is, if you look at this as a shape of a person, you got a shoulder and then the neckline here and then the head and then the other neck side and then a shoulder and then back down. Yeah, it's kind of a rough person, but that's what we got. This comes back down, so I'm basically going to guesstimate where my right shoulder is going to be over here, and then I'm going to get in somewhere in this range right here. So I may get in right here and then weather this movement until it finally drops down. Put a stop loss up here so that I protect my trade, but that's another reversal pattern that we have. Okay, and now let's look at ascending triangles. So this ascending triangle is where the market's moving up and hits the top here. Okay, so we're in an upward trend. No big deal, the market's just trending one direction. Comes down, marks a low, and then starts coming up, and then marks another, there we go. Okay, comes down, comes up, marks another top here, but doesn't break through. Okay, and then comes down a little bit, and then finally breaks through. That means that the top levels are pretty flat, and then the bottom, the lows that are coming off of that, the retracements are getting weaker and weaker, as then it'll break through. Okay, another one is Elliott wave. Now this is a more advanced pattern, so we're just going to mention it, but this one takes quite a bit of practice and learning to recognize and how to read the Elliott wave patterns, but almost all other chart patterns fit inside of Elliott wave patterns at one level or another. And so an example of an Elliott wave is basically the market moves in 5 waves up and 3 waves down, and they're counted 1, 2, 3, 4, 5, and then they're counted in letters A, B, C, and then you continue going 1, 2, 3, 4, 5, A, B, C. And so basically the patterns move up, and so right here you might have a head and shoulders. This isn't one, but you might see that, or you might see your ascending triangle as part of the top of this 5, and then it comes back down, gives you retracement, which is normally in 3 waves, A, B, C, and then it moves back up again. But that's the 30-second intro to Elliott wave, which is quite a bit more than that. All right, let's look at price barriers next. These are different types of levels on your chart. Through your technical analysis, they're going to show you where the market may be headed for or where it may be repelled from. Okay, these are things that'll give you an idea of what's going to happen next on a chart. And once you have a better idea of what's going to happen next, you can trade with that, and you can trade in any direction, so you can actually make some money. So let's talk about, these are turning points, these are targets, and the barrier types. Okay, so this first type is support and resistance. On your chart, you have levels of support, which is down below, where the market has turned, the bottom has turned and bounced off of a certain price. So 1.198.00 is a support level where the market came down, hit a little double bottom there, double bottom chart pattern, then climbed back up, came back up and hit 209, and that's a resistance level because it didn't break through 209, so it ran into resistance, hit there, came back up, hit it again, couldn't come back down, came down, marked another level at 200, which is another type of barrier, and then came back up. And it's basically so that the tops and the bottoms on your chart are basically support and resistance. The top extremes, the highest and the lowest points on your chart. And depending on what time frame your chart looking at, this is a daily chart on the pound dollar. So every one of these candles represents one day. So it came up, couldn't make it there. A couple weeks later, tried again, didn't make it, so it dropped down. That's a double top trade, if you can see that. Hit there once, hit there twice, didn't make it, so now it's heading down, and then it comes back down pretty good. Several hundred pips in here. At $5 a pip, you could make some good money if you understand these chart patterns. Okay, so that's support and resistance. We have psychological barriers. Okay, psychological barriers I have marked up as these gray lines are anything that ends with 50 pips or 100 pips. So 1.5600 is a psychological barrier. See that the market came off of this one, hesitated at this one, broke through that, hesitated at this one, came down, broke through, came back down through here, hesitated at this one. The market seems to hesitate around what are called psychological barriers. Big double zero numbers or big triple zero numbers. People are trading this market, and people tend to like to round things up or down. They say, "Oh, I'm going to stay until it gets to 5,600." They don't want to say, "Yeah, I'm going to stay until it gets to 5721.3." They're going to round things off, and so they place their stop losses and their take profits around these psychological barriers, and that actually makes the market react around those a little bit differently. So it's a good idea to keep an eye on the psychological barriers on your charts. All right, the next one is trend lines, and this takes a little more working because you've got to mark on your trend lines. The market loves trend lines, sometimes more than others, but the market gets into a trend going down, and you can usually find a line that'll line up with the tops of that trend. The market comes up, tags it, comes back. These are the breathing, right? We're going down, back up, retracement, progressive move down, retracement. Retracement tags a trend line, comes down, retracement tags another trend line, comes down. Here we got a double bottom, tagged, didn't make much more progress going down, so we're looking at changing directions, and that's when it might break through our trend line and change our trend direction. So we've got 2 clues here. One is a double bottom. The second is it broke through our 3-point trend line. 1, to 3 points on this trend line that breaks out and heads back up. So we draw trend lines to give us an indication of when the market might be changing trend direction. So I might want to get in about right here on this trade going long because I've got a double bottom that tells me it's not going down anymore, and it broke through my trend line enough to where I'm pretty confident it's going to continue to rise, and I might catch 100 or so pips out of this as it climbs back up in the opposite direction. All right. We also have multiple hit barriers, where the market comes down and tags something and just keeps hitting that same price level. So here's one right here. This level right here at 129, 1.2925 seems to be a strong barrier. It comes up, tags it, tags it, tags it, and just can't break through. Same thing on the downside, hits, hits, hits. The market's channeling. And so anytime the market hits the same price multiple times and doesn't break through it, that becomes a multiple hit barrier. Okay. We also have what are called Fibonacci levels, and we're just going to do a basic intro on this because Fibos can be quite a bit more in depth, but it's basically a mathematical calculation that says that the market generally will react or turn or change directions or be driven to these price levels. And so the Fibo levels that we want to pay attention to are most prevalent ones are 38.2%, 50, and 61.8. Now 50 is not exactly a Fibo level, but 50% on your fibs, you can put any levels you want on your Fibos when you're customizing these. 50% is a good, people say, yeah, it's going to come back up about halfway and then continue down. So whenever we're guessing or predicting where a trade's going to finish retracing and then continue down, we can use Fibonacci's. So you'll see that the market came down here and retraced up and paused right on the 38.2% and came back down, gave a little breather here, and then came up and hit the 50% and then said, okay, that's all I can do is 50%, and then it continued down with its downward trend. So you'll find oftentimes where it plays at these Fibo levels. And as you'll notice, it comes back down. This was a support level. Remember our support levels, the lowest point in the chart. When this came back down, that's where it sat for a little while because there was support there. It couldn't get through that without more people jumping on the bandwagon. And so it sat around for a bit, and then you see the bigger candles are when it usually breaks through those support levels. And the next type of barrier that we have is called overlapping barriers. Now, overlapping barriers are basically when any of these two or more of these line up on the same price level. So you might have it multiple hit the same price level. That's also a psychological barrier. And whenever you have overlapping barriers, then the market tends to think that that price level is more significant, and so it will have a better chance of turning around or reacting at that price. So climbing up here, the market hesitated around this psychological barrier and this Fibo level and came back up and hesitated and turned around at this psychological barrier at 2850 and this Fibonacci level here. So it came back down, bounced off this psychological barrier here, the 500 mark, hesitated, and then dropped through. So overlapping is when you combine any one of these two barriers here, 2 or 3 or more, to get good or stronger price levels to pay attention to. All right, so that's the end of that section. Make sure to watch the next video on this series on trading styles and strategies.